What's likely the most common argument against dividend and income investing is that dividends ultimately don't matter when it comes to stock market returns. It's an old argument that's been around for decades, and over the years, countless books, articles, and YouTube videos have been published on this idea that investors should not prioritize investing in dividend-paying holdings. Instead, according to the argument, investors would be much better off without receiving dividends from their holdings, and focusing more on share price returns is the best option for everyone. Now, over the years, I've refuted and debunked several arguments made against dividend and income investing. And from my experience, what's usually the case is the people who oppose investing for dividends don't fundamentally oppose it, as in they think it's a wrong strategy, but instead they oppose it because they think it's boring. They think they can earn better returns day trading or holding very speculative penny stocks that could double in 3 months. Or not even that, they think they can invest in a stock like Plantier and get out right at the right time very consistently. Most people who oppose dividend investing are usually under the age of 30 or 40, so many of them just lack experience in the markets. They don't want a passive investing strategy because they still like the dopamine that you get with trading in and out of positions all the time. So given how this argument is made so regularly, I wanted to dedicate this video to addressing it. When people say dividends don't matter, what they're advocating for is something called the dividend irrelevance theory. It was a theory that was introduced back in 1961 by 2 economists, and the main argument behind this theory is that dividends have little to no impact on a stock's performance. So basically, when you look at any stock, they argue that you should pay no attention to its dividend when determining how valuable it is, or if you want to invest in it. Proponents of this theory also argue that companies should never pay dividends because it's an ineffective way of using capital. Instead, people who believe this theory say that the money issued to shareholders as dividends should instead be used to reinvest back into the business. This should cause company values to increase since they're keeping all of that money that they would have given to investors, thus resulting in higher share price gains. Obviously, neither of these 2 economists, nor anyone who believes in this theory, is a fan of the idea of living off dividends. They believe investors should only care about one thing, which is share price movements. There's a few things that I would encourage people to think about here. First off, there's a really important thing to keep in mind about the economists who developed this theory. Merton Miller and Franco Modigliani were experts at analyzing private companies, not publicly traded companies. Most people don't know that, and that's important because private companies do not trade in the stock market. Despite that, however, their theory still persists, largely among index fund investors and people trying to sell you a day trading course. But if a company decides not to pay shareholders dividends and instead hold on to that money, that does not guarantee that their share price will react positively. It's very well known that markets are irrational. Although the share price of a stock can react to information like earnings announcements, they're also influenced by a lot of other factors. Share prices regularly don't move in conjunction with a company's fundamentals. It's why we have behavioral finance as an entire subject when studying the economy. The emotions of investors play a tremendous role in how a stock is priced. Many REITs have been significantly undervalued for years. If markets were rational, they wouldn't be trading at such a discount. Even if dividends ultimately don't matter from a valuation perspective, they certainly matter to a lot of investors. There are plenty of great reasons why dividends matter and why a lot of people benefit from them. Whether the market is up or down, people who live off dividend payments will always get their paychecks. Having to sell shares of a holding has 2 negative consequences that immediately come to mind. First, you have to relinquish part of your ownership in a company to fund your lifestyle expenses. Holding shares of any stock represents ownership in a company. If you own shares of Tesla, for example, you are considered a partial owner of the company. Likewise, owning shares of an index fund represents a small ownership in a very large collection of individual companies. If you want to fund your retirement and you're not a dividend investor, you have to sell your positions to pay for it. That was always something that never appealed to me. I don't want to be forced to relinquish part of my ownership in a company to pay my bills. I'd much rather have my investments pay me, so I don't have to do that. It's the exact same reasoning behind the second most popular way to invest, behind stocks, which is real estate investing. People are attracted to owning something that pays them cash flow that they don't have to sell. To this day, I still wonder why most people don't think the same way when it comes to dividend stocks. And then the second consequence of relying on selling positions is that retiring at the wrong time can ruin you. Let's assume Bob decided to retire on January 1st, 2000, which was a very common date for people to retire. Bob had acquired $1 million worth of investments, which are all in an S&P 500 index fund. Bob needs $50,000 per year to cover his living expenses, so that's how much he's going to be withdrawing from his portfolio every year. How much money do you think Bob still has today, 25 years later? Well, if you guess zero, you'd be right. In fact, he ran out of money back in 2016. Bob had no way of knowing that this wasn't going to be enough, and $1 million was a lot of money back in 2000. Now, of course, Bob could have lowered his living standards by withdrawing less money, and he could have gone back to work to cover his expenses. But if Bob would have instead been making $50,000 per year in dividends, he would not have had to have sold any shares in his portfolio. That doesn't sound pointless to me. Living off dividends provides you with stability that you can't get trying to sell positions. Let's also think about this. The dividend irrelevance theory always assumes that management is always using that kept money that would have been your dividends in the most efficient manner. It assumes every company would never use that money for inefficient or nefarious ways. But companies make poor decisions all the time. They introduce new products and services that bomb, losing shareholder value. They can make terrible acquisitions, which will cost shareholders a lot of growth. The board can also choose to give themselves larger bonuses and salary increases if they have extra money. I like getting dividends because I trust that I know what to do with my money better than a corporation does. Imagine you work for a bank and they offer you two options. They come to you and say, "We'll give you a $5,000 bonus, or we'll keep your bonus and use it to grow our business, which might result in growth and would open up new departments and a possible promotion later on." Everyone would take the $5,000 bonus. Likewise, I don't want companies that pay me a dividend to stop paying me so there might be growth later down the road. This idea that not paying a dividend is guaranteed to result in immediate company growth does not make sense. That's not how the market works. Let's also consider how many of the most successful investors of all time love dividend stocks. There's no greater investor in human history than Warren Buffett. Warren Buffett loves dividend stocks. He buys them all the time. If he believed in the dividend irrelevance theory, that companies that issue dividends aren't using their capital in the most efficient way, why would Warren Buffett invest in any dividend-paying company? Surely he wouldn't invest in a company with a foolish board who mismanages their finances by issuing dividends. Even if he believes dividends are pointless, it doesn't stop him from buying those stocks. Some people say that Buffett couldn't possibly like dividends that much because Berkshire Hathaway doesn't pay a dividend. This is not an issue though. Warren loves getting paid money, just like I do, and he doesn't like paying money, just like me. His love of dividends is a one-way street, and that's totally fine because that's also the case for you and me. I've said this many times over the years, but when it comes to dividend investing, it is a matter of personal choice. There's nothing wrong with preferring index funds or growth stocks over dividend investing. There isn't one investing style that's best for everyone. But there's a reason the dividend irrelevance theory is still just a theory 64 years after it was proposed. There's no hard evidence that conclusively supports it. But even index fund investors have dividends to thank for their total returns. Studies have shown that dividends account for the vast majority of stock market returns. So even index fund investors who might say they hate dividends actually owe a lot to them. Again, there's nothing wrong if you prefer index funds or something else. But dividends definitely are not pointless, and they help millions of people retire and retire early. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.